In this session, we will cover the accounting journal entry and also explain a bit more on the sequence of allocating the impairment loss in certain circumstances. This is best illustrated through an example. If the carrying amount exceeds the recoverable amount by 10 million, then we have an impairment loss of 10 million. The journal entry is straightforward. Debit impairment loss 10 million, credit goodwill 10 million. However, what if the impairment loss is 35 million, more than the entire goodwill balance? What is the sequence of applying the impairment loss to a CGU? Let me illustrate using a simple example. Refer to the carrying amount of Walmart's New York CGU. As you can see, we ignore interest-bearing debt. Hence, New York CGU's carrying amount is 85 million on an enterprise value basis. In practice, we prefer to use enterprise value basis because it's cleaner and easier. So we have a carrying amount of 85 million. We then calculate a recoverable amount of 50 million, resulting in an impairment loss of 35 million, which is greater than the entire goodwill balance. So in this instance, IAS 36 requires goodwill to be fully impaired. However, what about the balance of loss of 15 million? We still need to apply it somewhere. IAS 36 then requires the carrying amounts of fixed assets and intangible assets to be reduced on a pro rata basis. So this balance of loss of 15 million would need to be allocated to the fixed assets and intangible assets based on a pro rata of their current values. Now, why only fixed assets and intangible assets? Because these are under the scope of IAS 36. Other items such as inventory, receivables, and payables are measured under different standards. So while we use them for equivalency basis purposes, we cannot impair them in this test.